losses, the banks and the miners in particular?
We got absolutely smashed today, and if we have a look at the market, it was the banks and the materials, the miners, doing most of the damage. Now, the banking space, if we have a look at the financial space, it makes up 35% of the Aussie share market, and the material space is the second largest sector with 17% of the Aussie share market. If we have a look at that banking space, a massive tumble there, down by 2.8%. In fact, the biggest losses that we've seen only since the 23rd of May this year. But if we have a look at the material space, that was down by 2.9%, and that's the lowest, that's the biggest fall that we've seen for the miners since the 4th of March this year, when copper prices were at a 3-month low and we were seeing the National People's Conference underway. Of course, it was two key things which really whacked the Australian share market today. First of all was the massive FOMC meeting last night and talk of tapering off of quantitative easing, and the market's starting to price in rates to rise in the US from 2015 onwards. And of course, the other event was the first insight that we get into the manufacturing space in China for the month of June, and they were the flash HSBC PMI numbers, which were absolutely atrocious. There were a couple of bright spots on the market, and I think the one stock which was really worthwhile mentioning today was QBE Insurance, up by a massive 5.2%. There's really two key inputs that are key to QBE share price performance. One of them is a strong US dollar, which is positive for its shares, and the other is rising US yields. Now, we saw both of those in play today, and great news for QBE Insurance. In fact, just having a look at the 10-year US bond yields, and this is what the chart looks like over the past year, and you can see that we have seen the yields just absolutely going vertical at the moment. So looking pretty good, and great news for QBE Insurance shares. Also worthwhile mentioning News Corp, up by 1.2%, so that weaker Aussie dollar certainly having some sort of impact on some of the stocks. But otherwise, if I just bring up a market map, absolutely atrocious across the board. You can see it's a sea of red today.
And Julie, just on that, what sort of levels at an index level do we start looking towards now? I mean, obviously we like whole numbers, 4,700, but any particular technical levels?
If we have a look at the market, you know, the last few sessions have been quite bullish for the Aussie share market. And if I can just bring up a 30-day chart of the ASX 200 index, this is what it looks like. You can see that the market looks like it bottomed at 4650 points. And that's going to be a key level. If we see that breach, then we can expect some more weakness ahead. The biggest impacts, I guess, are because of that weaker Australian dollar that we're seeing. And if we have a look at the weak Australian dollar, it's great news for any of those domestic investors that did decide to invest offshore, because they'd be making a killing on the currency movements at the moment. But of course, not good news for overseas investors. And with the Aussie dollar forecast to fall even further, it does look like there may be more pain ahead. If we have a look at what overseas investors are really invested in, it is mainly the big four banks, and that's really why we are seeing pain in that high yielding space, because most international investors, they're underweight the resources at the moment. The flash PMI numbers today certainly not helping that resource space. They were absolutely terrible, so we did see a huge impact in terms of the big miners. But I guess just having a look at the technicals at the moment, and we are seeing that number on the 13th of this month, where we did see the market at 4,650 points.
Julia, it's Martin here. How are you doing?
Good. How are you doing, Martin?
Yeah, good, thanks. I don't know whether you're able to get a chart up on the Aussie dollar, but it's actually quite interesting. The Aussie dollar did a lot of work around 93 US cents for almost a year's duration back in 2009, 2010. I'm just wondering, from a technical level for you, does that mean that will add to some support around these current levels? Because it does seem to me the Aussie dollar has been absolutely smashed in a very short period of time, and maybe you'd have to question whether that's in fact justifiable given the Australian perspective.
I think you come up with a really good point in that we have seen the Aussie dollar moving so quickly in such a short period of time that it is looking at oversold levels. However, if we have a look at what's really driving the Aussie dollar, it's the macro picture, and really the whole world asset markets repositioning themselves for stronger US growth and the tapering off of quantitative easing. If we have a look at the Aussie dollar and just how it's traded intraday, this is what it looks like for the Aussie dollar. Now, we have seen some fairly big movements for the Aussie dollar, and they don't seem too clear, because we did see a massive impact from that FOMC meeting where the Aussie dollar did lose a few cents. But of course, if I just zero in a little bit and try and magnify the effect during the Asian session, this is what it looks like. And you can see there was also a pretty steep effect from the HSBC Flash PMI numbers, the manufacturing numbers coming out of China. So while we have seen a very steep movement and the Aussie dollar is looking oversold, I think in the short term, while we could see a bit of a bounce, I think the medium term, what's really driving this is macro positioning, and that's all about the US at the moment and the strengthening US economy and the tapering off of quantitative easing, and that of course is a strong US dollar story and unfortunately a weak everything else story.